You may not realize it, but every time you invest into a foreign stock or ETF, you are also, in a sense, making an implicit investment in a foreign currency as well. This is exactly what it says from this document that I found from MSCI, which basically asks the question, what is currency hedging and is it right for you? So in this video, I'm going to be exploring just that. Could you actually hedge your ETFs in order to get a more superior return on something like the S&P 500. Now, as you can see, this is my Trading 212 stocks ISA. Right now, as I speak, it is not doing too well. My main investment is down here. This is in the iShares Core S&P 500, the GSPX, which is actually a hedged version of the S&P 500. And personally, I have preferred this version of the S&P 500 because actually, realistically, I don't intend to hold it for the long term. I know the standard convention is to hold it for the long term. I feel like I'm doing something illegal, but just bear with me. A lot of what I do and have done since about 2022, all documented on this YouTube channel, by the way, you can go back and see all my different portfolios I've been doing this, is swing trading. And for me, I personally prefer the hedged version of the S&P 500. I find that it moves more in line with the S&P 500 that I see on Google Finance. And for me, that way it's easier to manage, when I'm going to buy and sell. If you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to click the link in the description box down below. Alternatively, if you've already signed up to Trading 212 in the past 10 days but haven't received a free share, all you have to do is to click the 3 horizontal line menu over here. Scroll all the way down until you see the section use promo code. And in this section, just use my code JUBAIR and you should receive a free fractional share. So let's compare the performance between the GSPX, the one that I choose, and the most popular in the UK, which is the Vanguard S&P 500. The VUSA. So as you can see, over the past year, this fund has returned to UK investors 10.92%. I say UK investors because this is actually in pounds. If you are a European investor and you invest into this fund, of course you can do that, but I don't know why you would do that because you're going to have to pay a currency exchange. And then again, the whole point of hedging is negated because there will be another currency exchange there, basically from the dollar to the pound to the pound to the euro. You're introducing so many variables. I would not recommend that. So this is the Vanguard Germany All Cap. These are both distributing funds, which means that the dividends are paid out to the shareholders instead of being reaccumulated back into the fund like an ACC version would be. Now, as you can see, over the past year, the performance figures are quite different, up by only 8.92%. Now, it wasn't too long ago when we saw that the S&P 500 was up by over 20% over the past year. So what has changed? Well, in fact, like I said, if you invest into a stock or an ETF in a different currency, you are also betting on that currency against your currency. So you are having exposure to the foreign exchange markets. But you might be thinking, Jubair, this is in pounds. What are you talking about? But as we all know, the S&P 500 are the top 500-ish companies, around 510 companies of the United States of America. All these companies, for example, Apple, Nvidia, Microsoft, they are of course American companies. They take dollars, even though they have a lot of business with other countries. For example, manufacturing almost definitely always happens in a cheaper country. But the bottom line is in dollars. And when you are investing in any stock or ETF that is not in pounds, if you are in the UK, then you are exposed to foreign exchange. So essentially, the pound and the dollar, or any two currency pairs, they're going to be fluctuating up and down all of the time. If the pound strengthens against the dollar, then that's what you're going to be seeing here, a loss in your actual gains. This is essentially because on the way back to pounds, it's getting harder to buy those pounds because they're more expensive, and this will be reflected back in the value of your ETF. So does it actually stand to reason that you should just get a hedged version of the S&P 500 and just enjoy the rewards? Well, in fact, it's not that simple, and I mostly would not recommend people to use a hedged version of an ETF for the long term. For one thing, as you can see, the expense ratio is more. So the expense ratio for the GSPX is 0.1%, whilst for the VUSA, it's 0.07%. So this is actually 30% cheaper, and 30% sounds like a huge amount, but they're both both very, very low in terms of their expense ratio. So it does actually cost more to hedge your ETF, and there are actually some risks that could actually happen. Big shocks in the foreign exchange market could actually mean that at some point big changes could be made, negatively in your portfolio if you are just using a hedged version of the ETF. But anyway, going back to this document, if you want to have a look at the document for yourself, I'm going to leave it in the description box down below. So you would use currency hedging to reduce exposure to foreign exchange risk. So, between the pound and the dollar for the S&P 500 in this circumstance. But you still want to retain the original exposure to the S&P 500, as in you want to track the companies of the S&P 500 like they are in America. However, you don't want that foreign exchange difference to be affecting your results. Now, currency hedging for ETFs has become extremely popular recently. As you know, more and more people around the world are getting invested all around the world, Asia, Europe, and now that companies are more connected than ever through their stock markets, it stands to reason that a lot of different currencies are going to be used in exchange for, bits of the, let's say, the S&P 500, bits of the FTSE 100, from currencies that are different from the stocks that are being invested into. So depending on your time period, of course, exchange rates can fluctuate quite substantially, and this could have a large and unpredictable effect on your gains, and that's all that really investors care about, their gains. For example, currently the central bank rates are different for the UK and for the US. Many factors, including this, can have a very big difference in the foreign exchange market. For example, right now it is more attractive to save money in pounds rather than dollars, as the central bank rate in the UK is higher. But if that were to drastically change, then foreign currency exchange will also drastically change. So as we have seen currently with the S&P 500, if there is a foreign currency difference between the time you invested to the time you want to sell, that could actually have a negative effect on the amount of gains that you have. However, like I said, there are definitely downsides of hedging. We are hedging because we want to reduce our risk to foreign exchange. But if the foreign exchange happens in our favor and we are hedged, then we can potentially again lose out on the gains of the market. And realistically, in the long term, how much will currency hedging actually make a difference? If anything, you are introducing more risk and more complication into your investments and increasing the costs of those investments. I would actually recommend for you to read this document here. It's very easy and simple to read, and they have a really good example here which I want you to read for yourself. So essentially, currency hedging, if it's right for you or not, will come down again to you, personal finance. If your time horizon is very long, like it should be, then currency hedging to me doesn't really make much sense. If you are more of a swing trader or want to do things more short term, then currency hedging could make a difference. But that being said, even in the short term, currency hedging could give you a negative result. The other thing is, if you want to currency hedge, then you are essentially betting that the difference between the pound and the dollar is going to go a certain way. And if you can convince yourself, then maybe go for a hedged version that will always be available for you. Again, at the end of the day, you have to manage your own risks as an investor. Don't just listen to me or anyone on the internet. It all goes back to the beginning. When you are investing into a stock with a different currency, you are essentially having exposure to the foreign exchange market. So make sure to check out some of my other videos, and I'll see you in the next video.